Just 5 days after the 5-year Canada bond yield hit the highest it has been since 2007, that 5-year Canada bond yield has reversed, dropping almost 0.2%, which means 5-year fixed rates have also reversed. And the question going forward is, how low will they go, and how is this all going to be affected by the current inflation picture? And in this video, I'm going to go into all of those details, as well as give you the best fixed and variable rates, both for discount mortgages and full-featured mortgages that are available as of today in the Canadian real estate market. But before I get into it, my name is Nolan Matthias, and if you want the latest Canadian financial and real estate news, this is the place for you. So do me a favor, hit that subscribe button and hit the like button so more people like you can see this video, and so that you have the absolute latest information on the Canadian real estate market. Oh, and by the way, this is the new home for Canadian real estate and mortgage and finance information. It is no longer going to be found on my other channel, so if you didn't realize that this is a brand new channel and you haven't already, make sure you do hit that subscribe button. Okay, so it's been an interesting news week, both for inflation and for bond yields, and that subsequently has an impact on fixed rate mortgages because obviously fixed rate mortgages are priced off of their comparable length bond yields, which I'll get to all of that in a minute. But what's really interesting here is that those 5-year Canada bond yields have hit the highest level since 2007. But in the last couple of days, it's reversed and they've come back 0.2%. Now the question is, why is this happening? And a lot of it has to do with forward-looking expectations, which the Bank of Canada obviously is very concerned about, pushing their forecasts for inflation and higher interest rates out to 2025. And for a second there, that had the bond market thinking, oh boy, interest rates are going to remain higher for longer. But then economists and market makers started really thinking about this and thinking about the messaging from the Bank of Canada and why they would extend those forecasts. And a lot of the reason for that was to keep those 5-year fixed rates boosted in order to pull back a little bit of the activity in the Canadian real estate market. Because the Canadian real estate market and interest rates and mortgage payments for that matter are one of the biggest factors affecting higher inflation. Now, that being said, we need to talk about higher inflation and lower inflation and all the things that came out in the news this week. So if we take a look at the most recent inflation data, this came out today, this morning. Total CPI inflation is now 2.8%. And I'm going to jump to a news article here real quick, then I'll jump back to this and explain what's going on. But that had many in the media jumping for joy that inflation was down to 2.8%, including politician, finance minister, Chrystia Freeland calling the return of inflation to the target range a milestone moment. But use some caution here, because that's not actually what's happening. What is happening is, yes, that inflation rate has come down to 2.8%. A lot of that is largely due to gasoline prices. Now, gasoline prices are a lead indicator. So in other words, when they start to go up, everything else eventually will go up in price as well because of transportation costs. And when they start to go down, that should filter through the economy. And if you take a look at the base year effect, so in other words, the effect of gasoline being so high last year and hitting its peak last year around this time, compared to now, what you are seeing is you're seeing the gasoline prices have a significant impact on that core inflation rate. In fact, if you take gasoline out of the picture, the inflation rate for this last month would have actually been 4%, not 2.8. And that's important to note, because what that means is that there's certain things in the economy that are having a bigger impact on this total CPI inflation than other things. And this is where we need to look to the other data. The CPI trim, the CPI median, the CPI comment. Now, I'm not going to go into the details of what these all mean, but essentially these are all ways of taking outliers in the inflation data and balancing it out. So taking out the things that have gone down a lot in value, like gasoline, and taking out some of the other things that have gone up significantly in value. And when you take those outliers out of the equation, you get a better picture of where inflation is actually at. And as you can see, these numbers are all significantly higher than the total CPI inflation. So 3.7, 3.9, 5.1. And what this means is that more than likely the Bank of Canada is not going to stop on their interest rate increases until you see those other CPI measures come closer to the total inflation numbers. In fact, let me just take you in here. I think we can quickly pull this up and take a look at the charts on this. If you take a look going back to 1996, what you can see is quite often these numbers are very, very close together. And this is what the Bank of Canada wants to see. They want to see all of these measures reasonably close together, because what that means is that values in the economy are moving more or less together, and there aren't significant outliers either going up in value or down in value. So you can expect the Bank of Canada to be cautious until such time as all of these measures come in line with each other, similar to what they were prior to the pandemic. Now, so what that all means is that we're still very much in a volatile market. So the inflation battle may have already been won, or it could be far from over. We won't know until all of those measures start to line up. But what that means for mortgage rates is that they are also volatile, and we're seeing that in the market right now. In fact, in the last 5 days alone, we've seen the bond yields come down almost 0.2%. Which means in theory, we should see fixed rates drop by 0.2% as well. But keep in mind that banks are often quick to increase interest rates when these bond yields go up, and not so fast to reduce them when they start to come down. That being said, the market's really competitive right now given that there's less transactions, so we're starting to see interest rates fluctuate faster than we've seen in previous years. And by the way, if you're worried about interest rates going up at any given time, you want to check out these Canada 5-year bond yields on a daily basis, and that will give you an indication of where things are going. If they start to go down, fixed mortgage rates will start to go down as well. And if they start to go up, well, fixed rates will start to go up as well. And keep in mind that these 5-year bond yields are the expectation of what the markets think is going to happen in the next 5 years. And what this is telling us, since these bond market rates are significantly lower than the Bank of Canada rate, is that the market expects interest rates to be lower 5 years from now. Now, with all that inflation talk and that bond yield talk out of the way, let's get into what you came for, which is the interest rates as of today. I'm going to go through the full featured mortgages and their interest rates. I'm going to show you the discount mortgages at the end and explain the differences. I'm not going to go into a lot of detail on those, primarily because those are the mortgages that come with restrictions and little tricks and tactics that are designed to get you to spend more money over time, even though you're paying a lower face rate. So let's jump in and take a look at what's going on with the 5-year fixed full featured rate. So these are the mortgages that have the lowest penalties if you end up in an interest rate differential situation. They're typically with what we call monoline lenders. So those are lenders like First National, MCAP, CMLS, which in my opinion are 3 of the best lenders in the industry. They come with full prepayment privileges, just like the big banks. But again, the big thing is those payout penalties are significantly lower if you end up in an IRD situation, which means you can have the opportunity, if interest rates go down, to pay the penalty and get into lower interest rates, which, by the way, you don't have with the big banks. These lenders have better mortgage products than the big banks because they have to. They can't skate on their reputations and their brands and their big marketing budgets. They have to have better products. And I still can't believe, when you have all of the criticism of big pharma and big corps in the US and all over North America, that the big banks aren't getting the same sort of criticism for these types of practices. Because the massive penalties and the restrictions that come with a big bank 5-year fixed mortgage are pretty similar to things like price gouging on medicine. It affects the people who need it most and can't afford it more than anybody else. Now, rant over, let's jump into those actual rates. So the insured rate, 5.34%. This has remained pretty much the same since the beginning of the month. But when you start getting into 20% down, this is what we can call insurable mortgages. So mortgages on properties that are valued less than $1 million, have 25-year amortizations. These have actually come down considerably in the last couple of weeks. So if you're putting 20% down, keep in mind that this is the riskiest mortgage for the banks because it's the level where you're putting the least amount down without insurance. So these are priced higher accordingly. If you start getting into 25% down, the interest rate is 5.49%. At 30% down, you're looking at 5.44%. And then at 35% down, you're back down to 5.34%. The reason why is because at 35% down, that mortgage is considered about the same risk as a mortgage that has insurance on it. Now, when you start getting into properties over $1 million, you start getting into refinances, you start getting into 30-year mortgages. These are all products that tend to have a higher risk associated with them and that are no longer insurable, while the rate is significantly higher at 5.99%. Now, the variable rates, on the other hand, we've seen prime go up, but the picture has gotten progressively better with respect to discounts. Now, this is going to change if the new OSFI rules go into place. You can check out the video that I'll link at the end to learn more about that. But if those new OSFI rules go into place, you can expect that these discounts are going to go down. But the discounts have progressively gotten better, even though the prime rate has gone up. Now, net, that means that variable rate pricing has gone up total. So as of right now, if you're looking at an insured mortgage, you're looking at 6.05%, so 6.95% prime rate minus 0.9. If you're looking at 20% down, you're looking at prime minus 0.55, so 6.4%. If you're looking at 25% down, it's the same rate. At 30% down, you're looking at prime minus 0.75. And at 35% down, you're looking at prime minus 0.9 again. Now, uninsurable, refinance, over $1 million, 30-year mortgages, you're looking at prime minus 0.25. So again, it pays big time to be purchasing a property that's valued under $1 million because you can get those insurable rates that are that 20 to 35% down range. Now, when we get into discount mortgages, keep in mind that these come with restrictions. It's just like everything else in life, you get what you pay for. So if you go into a car dealership and you see two identical cars, they're both Ford F-150s, they're both the same color, they appear to be identical, but they have different prices, well, there's going to be some features on one that you aren't going to get on the other. Same thing for mortgages. The big one here is typically what we call a bona fide sale clause. And the bona fide sale clause basically restricts you from being able to switch to a different lender or being able to refinance with a different lender when you get your mortgage. So in other words, the only way out of this type of mortgage is to sell the property. That's why it's called a bona fide sale clause. Now, you may think that's not problematic, but if interest rates go down, it is problematic because you are stuck with your lender until such time as your mortgage comes up for renewal or until you sell the property. Now, the big thing here is with variable rates, that also means that you have to lock in at whatever rate that they dictate. You lose all of your negotiating power, you can't leave, you can't switch to a different lender, so you pretty much are at the mercy of that lender, which is why we don't recommend these. If a client wants them, comes to us and says, I really want the absolute lowest rate, we will definitely go out and get it for them. But typically, once somebody understands the differences, they choose the full featured mortgages. And you have to keep in mind that 0.1, 0.2, 0.3% is typically a cup of coffee a week, depending on the size of mortgage that you're getting. So it's usually not worth it in order to get those lower interest rates. So it's usually not worth the risk to pay 0.2% in order to get a lower interest rate when you give up a significant amount of flexibility and pretty much all of your negotiating power. So, like I said, most people don't take these once they understand them. The big fear here is that people go out, see these interest rates advertised online, they end up getting the mortgage without knowing, and then they end up like all the people who come to the comment section here and complain about the fact that I promoted variable rate mortgages, even though the variable rate mortgages were adjustable payment mortgages, not fixed rate payments, and they went out on their own, got those mortgages without knowing that there was a difference because there's only so much you can put in a 10 or 12-minute video, and they end up with a product that they didn't fully understand. So my big piece of advice here is to make sure you know exactly what you're getting. Make sure that you go to multiple different places and get as much information as you can. And if you want to know more about discount mortgages and the different features and whatnot, you can get my book still for free, Mortgage Secrets, by going to mortgagesecrets.ca. It will give you the information you need in order to understand the differences between those discount mortgages and the full featured ones and what you're giving up in order to get that lower rate. Oh, and like I said, if you want to know more about what's going on with OSFI and why variable rate pricing may go up, make sure you check out this video right here.